Hello and welcome to the award-winning Standard Deviations podcast. This is our first one back since winning the Wealthy Award. Thank you to all our listeners. We were named Best in Class for the Thought Leadership Award. We're so honored by that, and I am equally honored to be joined by my longtime friend, Kurt Brown, here today. Kurt is the CIO of TownSquare Capital. He's the head of OCIO at Orion, and he is an adjunct professor at BYU, my very own alma mater. Welcome to the show, sir.
Hey, this is awesome, man. After all this time, I don't know what I did to warrant to be on the show, but I love being here. This is sweet.
Well, you did big things in the industry for a very long time, and that's what we're here to talk about. You're one of the most energetic, passionate folks I know in this space. I want you to tell us a little bit, for the folks that are unfamiliar, tell us a bit about what is an OCIO generally, and tell us in specific what TownSquare does.
Yeah, so, and we probably, it's one of those terms, OCIO, that's a little bit generic,
Sure.
and people give it a little bit different definition, but we really are an investment and trading group for hire for independent advisory teams. So you have a team that is a traditional wealth advisory practice that really gets to a place where they've maybe considered hiring a CFA to be their CIO, or maybe they've considered hiring a trader or something like that. And our group can take as much of that functionality off of your plate as you want. And we do it in a white label format. So we almost like become your employees. Our people really go to work for you, and it's been a really, really fun model to kind of play with in the TAMP space.
No, that's incredible. I can see the utility. Now, when I heard about this acquisition, I heard that Orion was going to be acquiring TownSquare. And our mutual friend and boss, Eric Clark, he came to me and said, "Hey, just a heads up, this is happening soon. Do you know Kurt Brown?" And I'm like, "Well, yeah, right? Like, I know Kurt Brown. I've known him forever." But I must admit, I had lost track of you a little bit. I had not kept super close tabs on you. And when I looked, TownSquare was only a handful of years old and had already accumulated some pretty significant assets in that 5 years. Like, to what do you attribute this, not overnight success, but very rapid success? How much were you able to raise in the 5 years?
It was a lot faster actually than we originally anticipated. Yeah. The answer to the question, I mean, we've been in business since the first quarter of 18, so it's been about 4.5 years, and in that time we've supported about 50 advisory practices or teams, and helped those teams raise about $6.5 billion in AUM. The answer really is in what the industry was missing. When I was co-managing kind of a long-only large cap growth strategy, we were working with a lot of TAMPs, but we were also working with a lot of wirehouses. And what I noticed was some of the most talented advisors were independent advisors. They were exceptional at building true high-quality financial plans, but they would regularly struggle trying to compete against the wires. So when you have a small firm that's trying to steal a $15 million account from Morgan Stanley, the client is sitting there and literally saying, "I actually like you more than my Morgan Stanley person, but I'm nervous to leave Morgan Stanley." And that's the hole that we kind of rushed in to fill for an independent advisor. So unlike Hightower or somebody like that, you don't need to come to us and rebrand TownSquare, right? We're going to come in and white label for you and let you punch above your weight. And we take a lot of client-facing interactions, like maybe 15 or 20 a week, help our advisors close, help them present, help them teach, help them build custom portfolios, help with high-touch trading, even things as sophisticated as hedging concentrated equity positions and things like that. So we become all of this, sort of analysis and PM and trading for these advisory practices. It gives them a lot of leverage, and it lets them compete, in a field maybe that they haven't been able to compete in before. And when you partner with the right advisors, people that are very talented with clients, the AUM growth can be really high. Our 50 teams that we supported in the first 4 years, we helped them grow their AUM about 60% per year for those 4 years. So when Eric and I first started talking, Eric Clark here at Orion, what has already been built at Orion, it was a really natural fit as a system for us to plug into with the technology and the other features that are here.
Well, it's an incredible testament to the need that must have existed in the marketplace that you were able to raise that kind of capital and get that sort of results in such a short amount of time. So, Kurt, one of the things that we know about human psychology, this is sort of Psych 101, is that there's a big delta between how people report on what they would like to do and what they would actually do, right? I mean, there's this huge gap. It's called the knowing doing gap. Like, we know we ought to be doing something. We know we ought to exercise, eat better, on and on. But then the way that we behave is often very different. And I see this knowing doing gap in our space among some of the advisors that you're talking about. Now, my dad, if you're listening, love you very much. My dad is a wirehouse advisor, and I'm always saying, look, why don't you go independent? And he has said, he said to me something that I'm sure you've heard a million times, is that, hey, I would like to go independent. I see the value of going independent, but he worries about the name on the door, right? He worries about going from a large wirehouse, one of the biggest banks in the world, to, Crosby Wealth Management. And so you believe that this OCIO function can help people like my dad, love you, make this transition. Yep. Talk to us about that and how to sort of close this knowing doing gap.
Yeah, and that's exactly what we're doing. A lot of our teams that we are supporting are former wirehouse teams. And they have come to expect a really high level of service and exceptional outputs. What we have found is in the years that we've been doing this, and I had these conversations when I was running my fund for all those years as well, is when a team makes that jump and they finally launch their own firm, I still have not met a single team that's regretted it. Because there is something liberating about having complete autonomy. You have nobody dictating to you what's best for your clients other than you, but you still have to have the horsepower, the best separately managed account managers, the best trading, right? The best services. And it's really hard for somebody that's been in a larger firm, especially a wirehouse, to have the confidence to leave. And that's what we do. One of our biggest teams that we brought over in the past year was a big team out of Manhattan at a big wirehouse, lots of very wealthy clients. And, it's been about, a little over a year now, and they are absolutely ecstatic with how empowering it's been for their business, how much they've grown since then. I actually think a lot of talented people at wirehouses they will do better than they think they will do out on their own. And we live in a world now where you can have access. I've been in the business 30 years in the capital markets, and for the first 10 or 15, you had to go to Goldman and Morgan and places like that to get access to the best money managers. That's gone. Access now is something that is relatively easy to achieve.
Yeah, no, that's incredible. So let's get into sort of the nitty gritty of asset management now and sort of behavioral wealth management. So one of the things that I managed to do, Kurt, in my book, The Laws of Wealth, was I managed to anger everyone. So I managed to anger passive enthusiasts and active enthusiasts. The active folks thinking what I was advocating wasn't quite active enough, and the passive folks thinking that I was sort of advocating, something that was far too active. So you've talked about this. I think you and I largely see eye to eye on these things. And one of the things that I've heard you speak about is something that I'm always preaching, which is so much of what is nominally active management is actually just expensive closet benchmarking. And I'll never forget coming across this research, shout out to Dr. Wes Gray and his team at Alpha Architect, where I first came across this research, which found that roughly 3/4 of nominally active funds don't differ in a statistically significant way from a passive benchmark. So effectively, you're paying full freight for something that you could get for very cheap. So I see benefits to active, I see benefits to passive, but I see no benefit in paying active fees for a passive fund. So can you talk about when investors should look for passive versus active exposure, and then how we can avoid paying full freight for someone who's candidly being deceptive?
About 15 years ago, when I was at my fund, we built a little simple program using Morningstar and some other tools. And we started doing portfolio examinations or portfolio audits. And we did them just as a service for people. And it ended up being a Trojan horse really to raise money for our fund. But here's what we ended up finding. Truly more than 90% of investors that have an active management approach in their portfolio are a closet index fund. And this is what the math is. And like I said, we've done about 5,000 of these portfolio examinations in the past 17 years. What you find is that anybody that owns an active fund owns an average of 14 different strategies, okay? And those strategies own more than 500 holdings each. So the average person that we've done an examination for owns 10,000 securities down inside of these funds, right? And so what? There's 4,000 listed equities in the United States, right? So you do the math. So what you really are doing is you've got your IRA, your Roth, your trust account, etc. When you mash those accounts together, you have built an expensive index fund that's also poorly built, because of the 14 funds you own, 11 own Apple, 10 own MasterCard. And then what happens is if you have taxable money, now you have 10 fund managers trading in the same security every single day. So while you and me are sitting here right now, in somebody's portfolio, there are managers buying and selling the exact same securities. So when they get the 1099 in January, they're getting murdered on the taxes in addition to the construction problem. So you're hitting on a real nerve of mine, because that almost nobody is doing great active management. And so the world I came from was institutional. We managed money for pensions, endowments, Fortune 500 companies and people like that. One of our biggest accounts was Koch's pension when I ran my fund. They had 400 equities in their whole pension, like billions and billions of dollars. And the average retail investor has 10,000 equities down inside of their account. So yeah, you are precisely right. This is what we see. So we love both passive and active, but if you're going to do it correctly in active and passive, whatever your choice is, right?
Right. Be active with conviction, or be passive and pay an appropriately economical price.
That's right.
Yeah.
Yeah, exactly.
In the current market that we're in, right, which is, volatile, which is a little spicy right now, how do you think about sort of the active passive debate right now? How would you encourage people to think about that?
Yeah, for us it never changes. The market never dictates to us, because advisors and clients should always be building portfolios that are preparing for the next bad period, right? The average year sees a 14% decline in the S&P 500 from its peak.
Yeah.
There's a 20% drop in financial markets every 4 years, going back 100 years. Okay, so you must have a portfolio that every morning when you wake up, you say, is today the beginning of the next 20% drop? And if your portfolio is not built that way, you have the wrong portfolio. So for us, it's irrelevant. Now, during those periods, of course, you're rebalancing, you're tweaking. You might overweight something, you might change something, of course, right? We live in a dynamic world, and our personal financial lives are dynamic as well. But from a construction standpoint, it doesn't change, right? The elements that you need for success, you need for success. The other thing is we don't agree with financial advisors that are approaching it like everybody needs the same model. So you're never going to hear my team say, okay, we're going to up our allocation to gold across the board.
Right.
Because every client is completely different in what success is for their portfolio, right? I mean, it's very personal to them. These financial investments are simply tools, right? And they have to be customized to that person, so.
Yeah. So one of the biggest behavioral errors that I know you're very keyed in on is people are very focused on alpha, but they often overlook what I'll call forms of negative alpha. And Morningstar did a study a few years back that has always stuck with me, and they looked at all the determinants of fund performance, and they found that the most consistent and the most powerful predictor of fund performance was price. Because price, as we've discussed briefly earlier, is a form of negative alpha, right? Whatever you're paying in fees is immediately eroding your potential performance. Now, you have this great saying you talk to me about, and you say that a lot of what Wall Street is doing right now is giving you a slice of watermelon wrapped in saran wrap that costs 4 times as much as the whole melon. So as the guy that buys the pre-cut fruit, as the guy...
You do? Do you buy the pre-cut watermelon?
No, 100%. I can't be bothered to mess with that watermelon. So as the fool that buys that expensive watermelon, tell me how I can keep from doing that in my investment accounts, and how can advisors ensure they're paying a fair price for their watermelon?
I love it. And by the way, it reminds me, do you remember the study Fidelity did like 15 years ago where they took the selections of the fund managers and scored them? And about 90% of their active managers beat their benchmark. But when you added the fees in, only like 30% beat their benchmark, right? So it's another way of saying what you're saying.
Yeah.
The cost can end up being the negative element to the alpha, not the security selection.
Well,
right?
Just a quick detour, excuse me, a quick detour there. So 2 things we know, right? We know this study, what you just said, right? That cost can, that value can exist, right? Stock picking value can exist, but it can be overridden by excessive fees. We also know that the highest concentration picks of active managers outperform historically, except they water them down. They put 10,000, there's career risk. So all this talk about, no one has stock picking prowess, passive's always going to win. Well, it's always going to win if people are charging too much and if people are acting out of cowardice and not having effectively active portfolios that are truly truly convicted. So it's one of those things where active managers are not as bad as they've been painted to be, but they do other things that erode their value.
Amen. That is so well said. And that's why we're such huge fans of high active share, high conviction. If you're going to use active, truly allow it to work for you, right? And, going back to your core question, there's a as you look at it in time, all these fund managers, sort of this negative alpha and what they do, there's these silly examples. And all it requires us is pressing a little bit. Okay, so go back to what I said earlier. The average person that owns an active strategy, and by the way, people do this in passive. I see people buying the same basic ETF over and over and over, right? Just replicating what they do. I'll give you another silly example. These target date retirement mutual funds that have become popular? Okay, what are they? They're simply, you are picking a year that you're going to retire, and some fund manager over time, as you get closer to that year, is slowly giving you more bonds. But if you pop the hood on what's in there, you're paying layer upon layer of fees for a really silly, ultra easy to administer index fund, is all you're really doing. But that's the saran wrap and the cutting of the watermelon. Wall Street will come in and put a fancy thing together. And then they will say, look how easy this is for you. But really what happens is you're giving all the alpha away and more. I don't want to name names, but the largest sponsor of target date funds in our industry, there's some great white papers about their target date funds. If you just yourself bought the underlying ETFs that they used in the target date fund, you made like 2.5% more net return per year. And there's like class action lawsuits against firms because they won't disclose that it's not the expense ratio. They charge the expense ratio on the wrapper and then all the expense ratios of all the sub funds, right? So the answer to your question is you have to be careful and ask the hard questions of your financial advisor, right? Like, what are we really buying here at its construction?
Yeah. So another form of negative alpha, we'll call it, is taxes. Nobody likes to pay taxes. It seems that everyone's always on the hunt for alpha, but we're ignoring things like tax alpha, which you touched on earlier, folks getting killed on their taxes. What can we do to avoid paying taxes? Right? What can we, again, looking for these sort of unsexy ways to ramp up our returns at a period of low expected forward returns. Managing tax alpha is one thing we can do. How could we be doing that better?
It's a big one. So I touched on one already. So to the extent that you have a taxable account or you're in a higher tax bracket, right? You want to use separately managed accounts, obviously, where you can, because traditional mutual funds, that's not friendly taxation. I think most of your listeners are already pretty well aware of that. I'm sure you've done a lot on that. But then even beyond that, once you're using separately managed accounts, you can then do a lot of tax harvesting strategically throughout the year. We saw, during COVID, for example, when you get a real whoosh down in the market, if you will not be a deer in the headlights, you can go in and do some harvesting of losses. And the IRS codes have changed. You can roll those losses forward forever now. So in the future years, when you have big gains, you'll pay no taxes, right? So you can go on offense about the way that you do this. Another thing is, be careful about how many people are managing your money. So for example, if you're using several different funds or even separately managed accounts and they're in different areas, you're not selling the best tax lot all the time. So what we'll do for our clients, for example, is let's say 2 of their fund managers do own Apple, and the client needs to do some selling. Let's sell the lot of Apple. That's the long-term lot, not the short-term lot, right? And we live in a world now where the software will do that for you.
Yeah.
But you have to be intentional in your approach of doing that.
Yeah, a little more hands-on, a little more thoughtful about this. It's one of the things, I think in bear markets, like the one we're in, I can't remember if we're officially down 20% at this point or not, but hey, it is what it is.
Close enough, right?
It's a bear market. So, right, in bear markets like this, I think you have to control the controllable, right? You have to get alpha where you can get it, and you can get alpha by managing your fees, being thoughtful about your diversification, and being thoughtful about your taxes. Like, I think you've covered a couple of naive forms of diversification today. People think they're diversified if they have multiple financial advisors. That's crazy, right?
Yeah.
People think they're diversified if they have 15 funds that all have a massive overweight to Apple and Microsoft and whatever, right? So I think you've given us a great case for working with people like you who are thoughtful about the things that you can control. So
one of the things that we do, I'll add one more to it, is if you're an advisor or you're just a client or whatever, and you log into Morningstar and you pull up a fund, be careful accepting that it is what it says it is. Okay, so we've examined the top 25 biggest mutual funds in the United States. Most of them are not true to what they're saying. You'll look at it, it says it's a large cap growth fund because in aggregate, it scores as a large cap growth fund. When you pop the hood at the holdings level of the fund, they own micro cap value, mid cap value, micro growth, right? The managers, especially the big fund houses, need to put a lot of money to work. They will hide it and park it in a lot of places. The same goes with your bond funds. It can say it's an investment grade bond fund and have 25% junk debt in it. So what a lot of people that are investors are overlooking is they're taking at surface acceptance. That's what the fund says it is. It's a 5-star fund, I'm going to buy it. Okay, you have to go one more level of research into what you're actually owning. Like,
what really opened my eyes to this, as someone with a great deal less expertise than you in these things, was the meme stock thing, where it's like I would have a mid-cap value fund or something, and I'm like, God, why does my mid-cap value fund own massive amounts of GameStop and Bed Bath & Beyond and all these things that just, because of some silly rule had triggered them into a place where, the largest holding in what's ostensibly a value fund is this meme stock that's trading for 2,000 times earnings. It's just, the theme that I'm taking away from here is just pop the hood, right? Look under the hood, work with someone like you who's thoughtful about these things and can tell you and help you know what you own. So Kurt, I got to ask you here as we wrap up. I know you're a steady guy. You talked about your sort of constant approach in good times and bad, but this has been one of the roughest years of all time for sensible sort of balanced portfolio.
Right, because even the treasuries are getting murdered.
No,
right?
treasuries
it's like
are getting
every
bonds,
cash is the best performing asset in the world.
Yeah,
right? It's
cash is the best performing asset in the world, and it's getting eroded at a mere 9% a year. Right,
exactly.
Right,
exactly.
So what hope can you give us? What thoughts do you have about going forward from the place we're at today?
I think we're actually becoming more constructive, I think, than most people now. We had been pretty cautious, and probably holding more cash on average because I tend to be a little bit on the conservative side. I've been in equities my whole life. I started on the NYSE 30 years ago, but by nature, I'm relatively conservative. I think most people have worked very hard for their money. and our job is to grow it, but really protect it. That's a lot of what our mandate is. But I think there's too much pessimism now. I think that the pendulum is swinging a little bit too far. Just rattle off a couple of things for you. One thing is 12% of all equities that trade in the United States now, the market cap of the company is trading for the cash in the company.
Wow.
12%.
12%?
12%.
Wow.
That's higher than we saw in the dot-com meltdown. That's higher than we saw even in 08. Okay? So the market as a whole is not cheap. The S&P 495 is quite cheap. You're down to 12 times, 11 times next year's earnings. Now, next year's earnings probably still need to be reduced a little bit. Estimates are probably still a little bit rich. But if you take out FANG M, you take out the big 5 or 6, 12 times next year's number. We were just running the data this morning, that we're getting somewhere. Okay, we're starting to get to a place where real value is showing up here, and I can't believe the level of pessimism.
Yeah.
When you look at University of Michigan coming in at a 50, combined with the fact that we still have a growing earnings line. Earnings are still up year over year. Margins are still holding in, right? And there's cash everywhere. When we went into the financial crisis, we had $1 trillion sitting in checking accounts in this country. We have $9 trillion sitting in checking accounts right now. My big high net worth families are sitting on so much cash that their thinking is, I don't know what to do with this cash. Okay, that's not an economy that's sitting on the precipice of folding house, right? So I actually think we're going to work through this. There's so much gloom and doom now. That's actually what's making me more interested. Like, sharpen the pencil, and you're going to have some very interesting opportunities. And I'm not saying this is the low. No one knows what the low is. But this is the time to be thinking about buying, not ejecting. Like this, we're getting to that part of the cycle now that I'm getting more interested. People are coming on TV with some real gloom and doom and this kind of thing. I actually think that the landing is going to be a little bit better.
Yeah.
Those I hate to be optimistic. I know in our business I'm supposed to be like really pessimistic and really dour, but it's not how I see things.
No, you need to balance out my natural tendency to be dour. So this is why I have you on, because it's so easy to fall prey to recency bias. And I mean, we came hot off a COVID crash to this crazy inflated market, and now another rough year. And it's just we've been whipsawed for a couple of years, and it's easy to become cynical. But I've been hearing about once you move away from FANG M, once you move away from market cap weighting and strict things like that, it looks pretty darn good. So something
and
to consider.
honestly, it's a lot of what's negative truly is negative. I really think our politicians have completely lost grip. Both parties, I think, are completely off the rails. I think the Federal Reserve got really, really behind, and I think the way that we dealt with COVID from a monetary policy standpoint, started out okay. You're going to come in and you're going to liquefy an economy that you're forcing people to stay at home. Yeah. But they got carried away. And politicians notoriously want to buy votes, and no one can pull the punch bowl away. And now we're paying the price. But it is a fixable problem. Inflation is a fixable problem. And it's a heck of a lot better to have to fix an inflationary cycle with really good fundamental underpinnings, which we have. Yeah. Households have less debt as a group than they have in 50 years. I mean, there's a narrative that, we have so much debt. Well, yes, the government does. But corporations and households are actually being really responsible compared to prior cycles because we got burned so bad in 08. So you still don't see a lot of people out over their ski tips. So I actually think it's coming our way, and the landing's going to be a little softer than the fear mongers right now would have us believe.
Okay, well, I'm gonna stop this podcast and go check out the S&P 495. But no, thank you for this. Absolutely incredible stuff. If people want to learn more about you, about your work at Orion and at TownSquare, where can we find you?
Yeah, just come to townsquarecapital.com. Our partnership with Orion is pretty new. We were just acquired by them here over the summer. And we're really excited about it because they've got some of the most unbelievable technology tools that we could take sort of what we do on the investment and trading side and pair it with, So yeah, if anybody's interested in that, and honestly, like even this portfolio examination tool, people are curious about this, and we'll do the exam. It doesn't cost anything. We'll just, if you want to run your own portfolio through it, we'll do it for you. So you can see, hey, what do I actually own down inside of all these funds? You know?
Yeah,
So,
love it.
happy to do it.
Reach out to TownSquare. Kurt, thank you so much. It's been incredible to see you rise, and best of luck at Orion.
It's fun to be here with you after all these years, man. It's
All
great.
right,
It's
man.
good to see you, Daniel.
Thank you.
Good.